Indian stock market ended the week with strong gains as both Nifty and Sensex surged over 1.5%, pushing the market to a new record high. For the first time ever, Nifty 50 has crossed the 25,800 mark, while the 30-share Sensex has breached the 84,000 levels. And it wasn't just the large caps celebrating. The broader markets joined in, with the mid and the small cap indices also posting strong gains of about 1 to 1.5%. So what's behind this rally? Well, overnight data revealed that US jobless claims hit their lowest point since May, signaling a robust labor market and easing fears of a slowdown in the US economy. As a result, the S&P 500 and Dow Jones Industrial Average surged up to 1.7%. Also, markets in Asia, including those in Hong Kong, Japan and Korea, followed suit, and domestic stocks rode the global wave. But the big question is, can this rally continue, or will the upcoming US presidential elections in November shake things up? To help us answer that and more, we have Rohit Srivastava, founder and market strategist at IndiaCharts.com, joining us. Rohit, thank you for giving us time here on News9. I want to begin by asking, why are the stock markets in India rallying today, and should we really trust this rally to continue, or do you think it's a one-day sort of a phenomenon?
Yeah, so two things have been happening, in this market over the last couple of months. One of them is that we've seen consistent rotation. This rotation has happened between sectors, those which are undervalued and out of those which are overvalued. So one belief system is that we can consider the idea that rotation will continue and the markets don't really have to fall too much. But at the same time, there are enough reasons to believe that over time, as stocks keep giving up and don't participate on the upside, you reach a point where everything needs to correct once and, release some of that pressure on the upside, reduce some of the valuations overall. For example, if we look at the mid and small cap segments, we see readings of the RSI hitting 88, 92 on the mid and small cap respectively. Very, very high level, last seen only in 2007. And that sort of, gives you a warning there on the broad market. If we look at the breadth over the last 1 month or 2 months, we do see that the most recent advance in the market, the number of stocks that are holding above, say, the 50-day average out of the Nifty 500 are far fewer now than they were before, So less than 60% versus earlier, it was more than 70, 80%. So when these kind of divergences develop, there will always be a fear of a potential correction. And that overhang will keep us from thinking that, this can rotationally go on, though that is what has happened for the last several months. So I think tactically, we'll have to take a mixed strategy between both of these, that at least you can reduce weightage in overstretched sectors, overvalued sectors, and you can actually start looking at interest rate sensitives, because we've just been through an FOMC meeting and lower rates directly impact sectors like metals, autos, financials, to some extent real estate. And a lot of the stocks that were gaining today are around those sectors. Like you see auto stocks like Maruti moving higher, most of the metals moving higher, even some of the oil and gas stocks attempting to go up. And that's an outcome of the commodity cycle, because commodity prices, which have been falling, would somewhere bottom out once the rate cycle turns. So that becomes the obvious target that, okay, I need to be long commodity related stocks, and I need to be probably cautious on the market as such. I can even have a short Nifty long metals exposure. This is also a seasonally interesting period, because out of all the months in the year, February is usually the worst and September is the second worst when we look at the average seasonal returns over a 10-year period. And so we will keep expecting that, there is that risk overhang in the near term. And therefore, it's not certain that the markets will hold up to higher levels. It may hold up on a sector or stock specific basis, but not across the board. That is my thinking.
All right, how are foreign investors viewing Indian markets right now? They have been on the sidelines for over a year now. Now, one school of thought says that, since the rate cut cycle has already begun in US and subsequently it will begin in India and other major economies, it will probably bring them back in full force. On the other side, analysts like Chris Wood of Jefferies think that the high valuations of Indian markets will keep them on the sidelines. What's your view?
Yeah, so we have seen to some extent, this whole idea that, foreigners tend to be sellers many months, but they've also been buyers in certain months. So if we just take the last 2 months into account, then they were net sellers in August. But so far in September, they've actually been buyers once the markets have stabilized at higher levels. So definitely they want to buy the dip. They want to look for a valuation correction before they enter. But they haven't got it. And which is why you do see you see alternate selling. And one month you see them selling a lot, and then next month you do see some buying. Now, at this point of time, even if I look at their positioning in the index futures, what I do end up seeing is that they have been long over there, and they've actually added back longs since the bottom in August again, and these readings are pretty high. So when we see high readings, we actually become on the one side cautious because excessive bullishness in the market can result in a market decline, and that is sort of been the history when we study positioning. But on the other hand, when I combine this reading along with what is happening in the cash market now in September, we would end up thinking that FIIs are now relatively bullish because they have been buying in the cash market and they are long in the futures market. So in that sense, their view is not so negative as of now. But I don't know whether sentiment, which means excessive bullishness, should be read into with some caution.
It looks like the market is, in a different sort of a bull run right now. Earlier, it was being driven by momentum, but those pockets of the markets are facing price pressure now, while the large cap stocks are providing the much needed support and pushing the markets higher. So, in a scenario like this, and with the US elections just around the corner, how should investors navigate the remainder of 2024?
Yeah, so US elections have seasonally seen some correction before the election. If we just take the last three election cycles, we have seen a correction in either September or October, and then post the election result announcement, usually in the first week of November, we've also seen a very strong rally. So if the same pattern has to continue, which we've seen the last three times, then also we would expect some potential pullback. So how do you really play this? I think some level of cash creation makes sense, even though, like I said, if this remains a rotational market, what has been happening is people are selling out of the overvalued sectors, which is PSUs, defense. Some of the renewable energy has been strong, but I saw some weakness in that this week also. And so these overvalued sectors or growth sectors, as we may call it, may actually cool off, and money goes into interest rate sensitives like autos, banking, real estate, and so on. Now, so if you're making that shift, or even if you're, if you want to buy at better values, then it makes sense to have some cash on the books at the same time, making these rotational shifts, because there is value, and that is where money is really going. It's chasing up value like it was doing pharma in the last quarter. Now it is doing the same in banking, because private banks that were underperformers last year are now actually extremely undervalued, private banks and NBFCs. So that is where you're seeing the money going, and that is the sector outperforming in the last couple of weeks. So you have to make those sector adjustments at the same time. Keep some cash so that you can buy the dip if it comes into late October.